Okay, so what we have here is the provision for depreciation T account. And as we had stated before, the provision for depreciation, also known as the accumulated depreciation, that is considered a contra asset, which is an account that reduces the value of an asset in the balance sheet. So not the accounts. It does not reduce the value of the asset in the T account itself, but it does decrease the value in the balance sheet. So when we did the balance sheet, you saw cost, you saw accumulated depreciation, and your net book value was the cost less the accumulated depreciation. So because the accumulated depreciation is a decrease or reduction in the value of a non-current asset, that is considered a contra asset. And why is that important? That is important because now we are going to do the provision for depreciation account for the non-current asset. In other words, we are going to do the accumulated depreciation account for the non-current asset. And since it is a contra asset, that means that this account, whenever it increases, it will be credited. So you know that the non-current asset or an asset is debited when it increases. Because a contra asset decreases the value of the asset, that means it will be a credit account. Okay, so you see this is the format here in terms of income statement and your balances. As we had stated before, the income statement, of course, what is next to income statement is the depreciation expense for the period which is entered or transferred to the income statement for the period to calculate your profit, right? Just like all other expenses. Your balances represent the accumulated depreciation or your total depreciation that goes in your balance sheet, hence balance. Okay, so the best way to do this is through an example, and we have activity 6.30 on page 270, and you would see from the information, a firm purchased a van, so the van is your non-current asset. They purchased the van on the for $18,000, so that is your cost, on the 1st of January 2013. So remember I had said when you see a date, it's usually like an alert. In this case, because the period is from the 1st of January to the 31st of December, we have no problems in terms of partial depreciation because it was purchased at the beginning of the period. So we good for that. We just have to work out what the annual depreciation is, and that will be your figure that goes into your income statement. So it is 18,000 is the cost, and the 1st of January it was purchased. It will be used for 3 years and then disposed of estimated value $3,000. Now, from the information here, no percentages were given, and they did not state which method, but because no percentages were given, that means it is the straight line method that we are going to use to do the working. So it's going to be a straight line method using the formula. So we see that the first thing we're going to do, have it highlighted already, is your working. And you could put down your formula. So your annual depreciation would be the cost minus the estimated disposal value divided by estimated useful life. So that is the formula we're going to use to work out our depreciation. And when we plug in the figures, that is 18,000 the cost minus the 3,000 estimated disposal value over your estimated useful life of 3 years. And that will give you a figure of $5,000. And since it is straight line method, that means that your annual depreciation for all of the years would be $5,000. Simple as that. This one was very easy, no partial depreciation or anything like that. We worked out our figure, 5,000 for each year, and this is what goes into your income statement. And then when we go to the account, you would see that it goes on the credit side because it is a contra asset. Okay. So the cost of the fixed asset, 18,000, it will be 18,000 for each year. And then just as we have been working out all of our activities before, so previous activities, your accumulated is your total for the period. So for 1 year, it will be $5,000. And your net book value would be the 18,000 minus the $5,000, which would be, oh, I did it this way. So we're going to work out the accumulated before we work out the net book value. About that, so this is the format that I use this time. You can do it straight across if you so choose. That is not a problem. But my accumulated for 2013, 5,000. My accumulated for 2014, it will be for 2 years, 2 by 5,000, 10,000. And then for 2015, for the 3 years, 5,000, 5,000, and 5,000, it will be 15,000. So there we have our accumulated, and therefore we can work out our net book value, which as usual is your cost minus your accumulated depreciation. So 18 minus 5 will give you 13,000 net book value. 18 minus 10,000 will give you 8,000 net book value, and 18,000 minus 15,000 will give you 3,000 net book value. So that is it for your table. You guys should be, doing that really quickly now because it's the same calculations over and over. Now what we are going to deal with for your account, your T account, the information that is needed would just be these two items, the two depreciation figures, which would be your annual depreciation and your accumulated depreciation. And we will see how that is shown in the T account. Okay, but notice that in the T account, you do not see the cost of your fixed assets and you do not see the net book value. Okay, so first thing we have to do it for the 3 years, and the first year would be 2013. So we're doing 2013. You will always start with your year because the dates that go underneath that is determined by which year it is. And since this is our first year, that means we have no balances, right? So we have no balance brought down. We go straight to the end of 2013, which would be 31st of December, and we are going to transfer our depreciation expense to the income statement. And from here, what you would see as your depreciation expense for 2013, $5,000. So $5,000, as you see here, we have income statement. What is transferred to the income statement would be 5,000 as the depreciation expense for the year 2013. Last thing that you have to do, because we have nothing else to enter in this account, you always balance your accounts at the end of the period. So on the next side, you're going to have 31st of December, balance carried down. And what would be your balance carried down figure? If your total on this side is 5,000, that means that your total on the next side is also going to be $5,000. So you have a balance carry down of 5,000, but what do you always have to do? Automatically, you have to now go and bring down your figure. Now, if the end of the period is the 31st of December, then what is the beginning of the next period? It will be 1st of January 2014. So the very, very first thing that we're going to have to do is we're going to have to put 2014, the year, to indicate that we have a new year. If we leave it out, that means you're going to see 1st of January 2013, which is incorrect, and you're going back in time. right? So we are going forward in time, 31st of December 2013, all years, New Year's 2014, and it is the 1st of January. So you're going to put 2014, and then on the credit side, you are going to put 1st of January, because your balance brought down from the CD, from your carry down, you always go to the opposite side as we just saw there. So you go to the opposite side. So again, you have your balance brought down, and that would be $5,000. Okay? And this is usually what I call the first part. Okay, you have your income statement on the credit side. You have your balance brought down, or sorry, carried down on the debit side. And then you will bring down your balance on the opposite side, which in this case will be your credit side. And then you can feel good, take your little break, and you're moving on now to 2014 in terms of the income statement. So we are in 2014 already. You're looking at 2014. If you see my cursor there, 2014, and you have the income statement amount as 5,000. So you're going on the credit side because it's a contra. Always credit side for the income statement. Income statement, what is the amount? $5,000. So you put in $5,000. And as you put in $5,000 on that, that is the only entries that you have to make for the provision. So now you're going to balance. How do you balance? You're totaling. Well, you go on the opposite side and you're going to put 31st of December, balance, carry down. We don't know what the figure is yet, or you may have already figured it out, but I am going to go through this step by step. Okay, if you already know how to get it one time, go through. But to get the missing figure, you go to the side that has the greater amount, which would be the credit side. So you're going on the credit side, and what figures do you have? You have 5,000 and plus 5,000, and that will give you $10,000. So you go to the next total, always make sure it's on the same line, because anything that is equal or balanced is the same level. That is why we always must have it on the same line, okay? It's like a scale. If it's equal, you're not going to see one up and one down. It's always going to be the same level. I'm emphasizing that for you guys. You will lose marks if you don't have it on the same level, okay? So you go across and you have it on the same line. And since it's supposed to be equal, you put the same $10,000. And therefore, on this side, to make this equal to $10,000, this figure, your balance carry down, will also have to be $10,000. This is where I point out to you. So let's go back to 2013. 2013, balance carry down, and therefore balance brought down, was 5,000. Let's go over to our table, and what you would see here is accumulated depreciation, 5,000. So for 2013, the balance shows your accumulated as 5,000. Let's go to 2014. For 2014, from your table, you will see that you had your accumulated depreciation as $10,000. Go over to 2014, and what do you see your balance as? $10,000. So this is how the account is showing your accumulated, and it shows your income statement. So for any period, if you look at the table, you will see 2013, 5,000 annual, 5,000 accumulated. Go over to your account, 5,000 annual, 5,000 accumulated. For 2014, you would see it's supposed to be 5,000 annual for your income statement, 10,000 accumulated depreciation for your balance sheet. Go over to your account. What do you see? Income statement, 5,000, balance sheet, accumulated 10,000. So it is showing the exact amounts for both your annual and your accumulated depreciation. So we have these figures here, but what is the next step? Because you're not finished yet, you always have to bring down your balance. So you're going to bring down your balance, but it's a new year. It's no longer 2014. We are celebrating New Year. Yay! 2015, here we come, and it's the 1st of January on the credit side because your balance carry down is brought across. So you're coming this way, and your balance brought down will be the same $10,000. And that is where you can take a little breather. You have just finished the steps, and now you start the step over again. And what's the first step? You're in 2015. First thing is to put in your annual depreciation. Which side does it go on? Always the credit side. So you come on the credit side. It's always done at the end of the year. So 31st of December, income statement. What is the amount for 2015? $5,000. Put in your $5,000. You're good. Then you have your balance, because that is the only two items that go in. Going to keep on pointing out. Look at this side, what you see: balance, income statement, balance, income statement. Right? Your balance brought down, your balance brought down, income statement, income statement. On the next side, your debit side, balance carry down, balance carry down. What you think you're going to see on this side? 31st of December, balance carry down. So it's the same thing over and over. The only reason we don't have a balance brought down for this one is because it was the first year. But notice, always balance brought down on the credit side, always income statement on the credit side, always balance carried down on the debit side. So you see that? Debit side balance carried down, credit side balance brought down, and income statement. And then you always have your totals and your dates, of course, with your year starting off your dates. So we have our balance carry down. Going to work through the process. You may have already figured out what your balance carry down is. Just to point out, it is supposed to be the 15,000. So let us just check and make sure it is going to be the 15,000. So you go on the side with the amounts, the total, 10,000 plus the 5,000, and that will give you 15,000. You go across to the debit side, and on the debit side, you will have, so you're going across to the debit side, and on the debit side, you have to have the same $15,000. So we get there, 15,000. And therefore, your balance carry down will be, look at that, the $15,000. That is supposed to be the accumulated. Okay? So as we get there now, what's the last thing that we have to do? You have to bring down your balance. Right? Even though we are not going to be doing for another year, the last thing you must always do is bring down your balance. So it's a new year, it's 2016, 1st of January, you're bringing down your balance of $15,000. And that is your section there completed for, and you have your 3 periods. You have 2013, 2014, and 2015, right? But you always end with your balance brought down. Okay, so there, of course, this is a video, so you can go back and you can review it. If you prefer to keep your notes and take your screenshot and put it in your own folder or your notes or so, you can do that at any point in time. This is what is required for a T account each time. You calculate your annual depreciation, you will calculate your accumulated, and then you have to plug in those 2 figures into your provision for depreciation account. And let me emphasize again, the name of the account is Provision for Depreciation, and you must put what the name of the current asset, sorry, the non-current asset or fixed asset is, which in this case is a van. All right. So your activities, which will be due for next week, next class, you have 3 wonderful activities. 6.31 is just like the one that we just did. So you're going to do your calculations and then you're going to plug in your figures at the bottom here. 6.32 does not give you the table to work it out. So you are going to have to organize your working. Hence, furniture purchase. Furniture is a straight line method. So you just have to do one working for the furniture, and that will be the amount that goes for income statement for each year. Okay? For the reducing balance method, I would suggest that you could probably just draw a line down to separate the two. And remember, when we were calculating our reducing balance, we would put the year and then we will do percentage by net book value. And then you will just work out what the annual depreciation is. You can put it like that. And then you do the same thing for the next year, 2013, and then the same thing for 2014. Okay? And we just remember that the first year, 2012, the net book value would be your cost. Okay, and then your net book value for 2013 will be what you calculate as your net book value after you have done your annual depreciation for 2012. Okay, so once again, I suggest you can just draw a line, show you're working for furniture, which is straight line, straightforward. It will be the same thing for income statement. Then for the reducing, you can just put it down by years, work it out, and then you would plug in the figures for your motor vehicles. Next to income statement, you would see whatever you calculated for each year. And then the last one, 6.33, very interesting. I suggest that you do it in pencil because this one is requiring that you do the actual non-current asset account, and then you get your balances for each year or your cost for each year for this account. Note, they said full year's depreciation, so don't bother with the partial depreciation, okay? Once you have calculated your annual depreciation, leave it like that, all right? Because it stated that in the question. But this one is an interesting one. I want you to attempt it. This is revision for your non-current assets, how you're going to put the information in your non-current assets. And just remember, the hint is your balances to be used, your cost figure to be used for calculation of depreciation each year would be your balance for that particular year. Okay, so I'll be interested to find out and see how many people get especially 6.33 correct. And that is the lesson for today, and you go off to do your assignments.